Hello number-curious friends, welcome to the channel where we talk accounting and finance. Today we unpack three lines that often confuse beginners: provisions, accruals and other liabilities. You will learn what the terms mean, when to record them, simple journal entries, how they show up in cash flow and the most common mistakes to avoid. But first, a quick refresher. What is a liability in general? A liability is a present obligation from the past event that will lead to an outflow of resources. In plain words, you owe something. On the balance sheet we split liabilities into current, due within 12 months, and non-current, due later. Today we talk about the current ones. So, what is a provision? A provision is a liability with uncertainty about timing or amount. The most common reason: you have not received an invoice yet, but you know that you have received goods or services and you will need to pay your supplier soon. You record a provision only when the three tests are met. There is a present obligation from a past event, an outflow is probable, more likely than not, and the amount can be reliably estimated. If any test fails, do not book a provision. You might disclose a contingent liability instead. In short, you think you owe or will owe something, but not sure how much and when, and what is the probability of that. As an example, some potential lawsuits that you may face. Typical provisions you will see include warranties. These are for expected costs to fix products sold or services provided. Customer returns relates to expected cost of returns not yet received. Onerous contracts. These are for the contracts where unavoidable costs exceed benefits. Legal claims for probable cases with costs which can be estimated. Restructuring. But this one you book only when there is a detailed plan and a valid expectation created with those affected. Unused vacation. Costs related to employees who are expected to take annual vacation but have not done so. How do you assign value to a provision? You should measure a provision at the best estimate of the outflow. For many similar items, such as warranties or returns, you would normally use an expected value based on experience. If the timing is long dated and material, you should discount to present value and unwind the discount as interest expense over time. In addition, it is always a great idea to review provisions each period, increase, use or reverse if no longer needed. And before we move on, if you find our lesson useful, please take a moment to hit a like button, subscribe to our channel or leave a comment. And thank you for being with the channel, this is very important to me. What are the accruals then, you may ask? These are also liabilities, but usually routine and short-term estimates for goods or services already received when the invoice has not arrived. For example, utilities for the last months, payroll earned but unpaid, including bonuses, audit fees incurred but not yet billed. Think of provisions as uncertain events that need judgment and accruals as temporary estimates of a regular cost. And now a few words on other liabilities. Other liabilities is a bucket for current and sometimes non-current items which are not trade payables or borrowings. Common items will include deferred revenue, also called contract liabilities in IFRS, cash received before you deliver. This is similar to prepayments received, which will also often sit in other liabilities. The difference is that prepayments received are normally for one-off events and deliveries, while deferred income often relates to recurring revenue, where you expect to issue similar invoices for the same type of services regularly, for example every quarter, 6 months or a year, and deferred revenue is normally recognized evenly over time. Another part of other liabilities is taxes payable, VAT, payroll tax, corporate tax. And another one, wages and social charges payable, or interest payable, or dividends payable once declared, and also a current portion of long-term liabilities, for example, these liabilities due within 12 months. Now let's get back to our Apple shop. Let's imagine we sold apples for $20,000 and gave our customers guarantee over them. As some customers typically use our guarantee and want us to replace spoiled or damaged apples with new apples, a warranty provision for such request is created. Based on our experience from the last 3 years, we estimate that warranty cost for us is 2% of sales per year, and on 20,000 sales we expect $400 of costs. So, we record a warranty provision of $400, and the journal entries would be: at the point of sale we record debit warranty expense $400, goes as an expense into income statement. Credit, provision for warranties, 400, liabilities in the balance sheet. When we replace apples under warranty for $50, we record the following. Debit, provision for warranties, 50, we use it. Credit, inventory, 50, we replace apples and take them out. You can see that there is no expense. We have already recorded the expense in the P&L when we recorded a provision. Now it is a utilization of the provision, only the balance sheet movement. Decrease in the provision on the liability side and decrease in inventory on asset side as we replace spoiled apples with the new ones. Balance sheet balances. As at year end, you now estimate that only $300 of provision is needed and 50 is already used. So 400 minus 50 is 350 left, and you need to reduce it for another 50 to get to 300. You record debit provision for warranties 50, to reduce it, credit warranty expense 50, to record an income from the release of the provision. For the customer returns, provision logic is the same. We look back and see that historical returns were 3% on $20,000 of sales, so we expect 600 losses. Let's imagine we cannot use apples anymore and need to throw them away. The journal entry would be debit returns expense 600, credit provision for returns 600. When goods come back for $200, we record debit provision for returns, we used it, credit cash 200, we need to send a refund to our customer. What happens when we can reuse and resell our apples? We will put them back into inventory. How the returns of inventory are accounted for, see the top right corner for a lesson on inventory. Let's have a look at an onerous contract provision. Again, the logic is the same. Imagine we may need to sell apples with a huge discount. Unavoidable costs are $5,000 and expected revenue is only $4,200, so we provide for $800 now. Debit onerous contract expense $800, credit provision for onerous contracts $800. And now accruals for utilities at month end. We estimate we have used and need to pay $300 for electricity and water we have used last month. The journal entry would be debit utility expenses $300, credit accrued expenses $300. When the invoice arrives next month, but only for $290, yes, let's complicate it a bit, we record the following. Debit accrued expenses $300, we need to fully remove the provision from the balance sheet. Credit accounts payable $290, we now have an invoice and need to pay exactly $290. And credit utilities expenses $10. We reverse the overestimated expense for $10. Total entry is $300. It adds up. When we pay, we record the following. Debit accounts payable $290, credit cash $290. Another interesting part of other liabilities is deferred revenue, or contract liability in accordance with IFRS, where we receive cash first and provide the service later, but we will do a dedicated lesson for it. How are provisions and other liabilities reflected in cash flow? In general, as all other liabilities, they behave the same. Actual payments for provisions normally appear within operating cash flow. In the indirect cash flow, increase in provisions or accruals adds back to operating cash flow. Cash saved for now. Decrease uses cash. You are paying off liabilities. Please always consider changing accruals and provisions with trade payables, because when the invoice arrives, there can be a reclassification between both. Are there any differences for provisions in IFRS versus US GAAP? Both frameworks follow the same logic for provisions. Present obligation, probable outflow, reliable estimate, and the same idea for accruals and contract liabilities. Wording can differ and discounting thresholds may vary, but in general the treatment you saw here works under both sets of rules. Here are a few good habits to follow for provisions. Keep a roll forward schedule for each provision, opening balance, additions to it, usage, reversals, and closing balance. Such roll forwards are extremely useful and help you understand what exactly happened, not just to see opening and closing balances. Document assumptions and data sources, return rates, spoilage rates, legal letters. Review aging of accruals and clear rolled items which are no longer needed. Link deferred revenue schedules to contracts. And segregate duties: who estimates, who approves, who posts. And now a few common pitfalls. The first one, book in provision for future general operating losses. This is not allowed. The next one, creating a restructuring provision without a detailed plan and communication. This is too early. No obligation exists and the amounts may move a lot. Forgetting to reverse provisions which are not needed. Review them regularly. Mixing accruals with trade payables. Keep those separate. Recognizing revenue while cash is still a customer prepayment. Keep an eye on timing. Fix all of this with clear criteria, schedules and monthly reviews. Now let's summarize the lesson. Provisions cover uncertain obligations which meet 3 tests. Present obligation from the past event, outflow is probable and the amount can be reliably estimated. Accruals cover routine short-term estimates. Other liabilities gather items like deferred revenue and taxes payable. Use clean entries, keep roll forwards, and let cash flow changes tell you the story. That is provisions and accruals in plain language. In the next lesson we will cover deferred income or contract liabilities. If you have other questions to provisions, post them in the comments below and I will look into them. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next lesson. See you soon and keep those debits equal to your credits.